Hey guys, welcome back. In today's video, we are talking about the highest AMC week, how long it will take to get to 5,000, the short sales failing, and many more in this video. First, we're taking a look at this. Last week, I got to tell you that 4.5 million people were guests at AMC theaters and Odeon cinemas. Big numbers. But now, I have the distinct privilege to tell you that more than 6.9 million people were guests at our theaters this week, our highest attended week of 2025. So if you wanted any data, any indications of whether or not the movie industry is going well, whether or not AMC is doing well, this is what you should be looking at. Now, this is very important because it directly relates to the fundamentals of AMC, because this relates to ticket sales, this relates to food and beverages sales, and of course, many more along with that. And so by understanding we're breaking records, by understanding we know that more and more people are coming in, we are expecting a very good Q4 for AMC. It's good to know that in a booming industry right now, AMC is definitely captivating on what's there, especially when you mix that with obviously what has been implemented by AMC. You can see we can get used to these record-breaking moviegoers, keep up the great work, where we are seeing how people are obviously flocking to AMC. And one of the big things is how AMC recently released the popcorn pass. And we talked about how that is, of course, another increase in their sales, whether it's by people purchasing the sales or whether it's then people using this purchase to then buy popcorns with the pass, because that itself was the incentive. And this is how we understand that AMC is benefiting from everything that's going on right now. It's one thing to obviously see our ticket sales increase, but then a whole nother thing to realize how is AMC able to then get revenue from other different areas. And this is what we're looking at. And I expect, especially believe that AMC will captivate on this opportunity that is presented to them. And this is why we've said that more and more people are realizing the opportunities with AMC. More and more people are understanding how AMC in this current environment is able to benefit, is able to really improve their infrastructure. And this is the proof of it. And if you want to take a look at the domestic box office, you can see for Sunday, November 13th, 1.2 billion, Sunday estimates 42 million, November total estimated at 788 million. And so this is what we're looking at, and this is for Q4 that we are seeing. So it's been a great October, it's been a great November, and we expect it to be a great December as well. For people that have watched these videos, you will know that one movie I'm especially excited for is, of course, the new Avatar movie. And so this is something that I think will also allow AMC to do well for Q4. And the reason why I keep on stressing about this is because fundamentals has always been a key part of AMC, as it should for any company, as anyone is aware. But it's the fact that we released the popcorn pass, we have all of these new things coming out. We see how AMC is able to benefit off of food and beverages. So if more and more people are coming, naturally we are expecting the revenue to go up. Naturally, we are expecting for the average spending at AMC to also increase as well, allowing the revenue to increase. And so when you want to know whether or not fundamentally it's a good investment, is there any improvements in the earnings and the fundamentals? Well, these are the indications that are given to us. We don't, of course, for sure know exactly what the Q4 revenue will be, but the fact that we are seeing how well it's doing, we can expect it to be extremely good. Now, it's because of this, we're seeing more and more capital flow into AMC. We're seeing AMC do well. Last week, we saw AMC up 15.71%. And you can see, fun fact, if AMC were to move 15.71% every week, the share price will be $4,835 in a year. So if you want to know how long it will take, this is approximately, how it will allow AMC to get there. Now, we've already said this, and I want to make it very clear. I've said this multiple times. The AMC's true price is not what's shown on the chart. I'm sure this is what 99% of the apes, of retail investors, will agree on, is that the price we're looking at right now is not a true price discovery because of the multitude of these manipulation tactics that have been used by these institutions. Now, should it be 4,835 just based on the fundamentals allowing real buy pressure? I've already stated this. I don't think so. I think AMC can easily be in the hundreds, but it can't be in the thousands. Does that mean it will never get into the thousands? Of course not, because that's when you account for the squeeze, when you account for the covering of these synthetics, and then it will shoot past that. But I'm sure a lot of you also believes that AMC's true price discovery is anywhere in the hundreds. And so it would take us a year for 15% every week to get to 4,835. Just think about how quickly it can be for AMC to get to $400, which with the current state, with how AMC is improving, with how AMC will improve, especially the fact that they are likely to make even more money now, and then they can invest into infrastructure, they can improve their earnings, you're going to see how fundamentally AMC will be worth even more. And is why we believe that seeing the 15% every week for AMC is extremely doable. Seeing AMC to go up in the hundreds is also extremely doable. It's even with the manipulation. Now, with the manipulation then accounted for, we are going to be facing struggles, but does that mean I don't believe it will never reach there? No, of course not, because I do believe in what AMC is doing. I do believe in what they will be doing, and I'm sure many of you also understand that as well. And now, because of this, because we're seeing the optimism, because we're seeing how investors are extremely confident, how investors are buying into AMC, we're starting to see news articles like this. You can see the analyst given out for AMC is that Robinhood, and the very fact this is starting with Robinhood should already give you an idea of what's going on. But let's just look at this. Robinhood trading data shows significant net selling over the past week, with net flow percentages as low as 34.82% on November 28th. Buy volume has declined while sell volume surged, indicating retail investors are reducing exposure despite positive company news. Now, this is ridiculous on so many different levels. Firstly, let's look at this. Retail investors are reducing exposure despite positive company news. Now, you can already see how stupid this is, because they're meant to tell us that throughout the last 5 years, every time we saw negative news, we bought into AMC. The moment we see good news about AMC, we decide to suddenly sell our position that we've been accumulating for the last 5 years. Now, that already sounds stupid as I'm saying it out loud. I'm sure it sounds stupid to you guys too, but this is what we are looking at. This is what they're trying to say. They're trying to say that retailers are leaving because AMC is showing positive company news. And the very fact I have even to talk about it is already making me laugh. The second thing is the fact they're saying sell volume surge. When we take a look at the net inflow, it's been doing extremely well. When we take a look at how apes have continuously bought into AMC, we know that the net inflow is actually bigger. And the fact that they are saying that in total that there is more sell volume than buy volume, despite the fact we're not only seeing retail buying, but we're also seeing institutions buying, that's what the problem is. They're trying to say that retail investors are leaving because they want to make space for the institutions. We have seen institutional accumulation, we have seen institutional ownership for AMC at the highest it has been. And they're trying to play this off by not saying because they're buying synthetic shares, but by saying the fact that the reason why we are seeing an institutional ownership of 30% and not a retail ownership of 90% is because retail have sold. They're not talking anything at all about institutions buying. And that's because they want institutions to buy. They know that institutions are buying. They're making space for institutions. And the only way for them to make space is to get retail investors to leave. Little do they know, we will never leave. But this is just how stupid this post is. And it's especially ridiculous when we understand everything that is going on. I think just the last part should already let you understand just how stupid this is. The fact that retail investors are leaving because of positive news. I think that should already tell you a lot about what this thing is. And then you take a look at this. UBS recent purchase of 23 million AMC shares in combo with the acquisition of an undisclosed short position from CS suggests AMC may squeeze, but no one knows to what level. For what it's worth, AMCflow.com was up at $4,200 right before the site was closed down end of August. So another thing that they're not trying to say, but that's because they're secretly paving the ways, is we've seen UBS acquiring massive AMC shares. And that was already an indication of how the short sellers of AMC are in drastic need of AMC shares. The very fact we know that UBS inherited a position from Credit Suisse, which is now forcing them to buy AMC, means the same for all of these other short sellers as well. Is why you see Citadel buying AMC, is why you see Goldman Sachs buying AMC, because all of these short sellers need AMC shares. But the problem is there is a lack of liquidity for AMC shares without making even more synthetics. So how can they get more AMC shares without creating synthetic shares? As the answer, as you will know it, is to get it from retail. And so this is what they are failing to mention, but they're trying to create incentive for retail to sell. They're failing to mention that institutions want to buy shares. But by saying that retail are selling shares, they're hoping that that would cause retail to then actually sell shares to allow institutions to buy. And so this is what we're looking at right now. It's for you to understand, how well AMC is going to do in terms of the potential for AMC. And something that I find ridiculous is that, yes, we're seeing positive news for AMC. And this is something that shouldn't be told to you by these articles, but by things we're seeing. The very fact we're seeing that AMC is seeing record attendance, that is knowing how AMC is going to do well. It shouldn't be by these articles. It should be by the data that AMC is actually showing. But then when you look deep into it, you can see you realize that they're just stuck on their bad positions since good news equals stock drop. So that we talked about how AMC is doing well. We talked about how the metrics are extremely well right now, yet AMC was down 4.08%. Now, the thing I find ridiculous with this is because last week we saw how news articles was claiming that AMC was up 2%, AMC was up 6% because of things like popcorn pass, because of the box office. And now, as we see AMC having a record attendance, meaning that they are making extremely high revenue from how well the box office is doing, suddenly it doesn't work the same way anymore. Suddenly we're seeing the market, or at least for AMC, to go down, despite the fact we are seeing the same news, if not better news than last week, yet we're not getting the same result. And that should just show you that they are stuck in these bad positions and that they are worried about what's to come. They realize that this record attendance is a very, very big thing for AMC when AMC realizes how to captivate on these record attendances. And then another case is, of course, AMC's investments. I think it's safe to say AMC Theaters is going to be deep in the money on investments in Hycroft mining when it's all said and done, and this will have a massive implications on debt reductions. So we've seen how silver is doing right now. We're seeing how the market is reacting. We're going to be looking at how these stocks will also reflect on that, one of which being Hycroft and, of course, AMC Theaters investments within that. And that will be playing a big part because it shows how well AMC is investing. It shows that no matter what way they steer, no matter the different strategies that they've implemented, they are all doing well. And it's a big reasoning for why short sellers are extremely scared when it comes to AMC raising money, because they realize how well AMC is able to use that money, how much return they can generate. And if AMC is able to generate money, that defeats the shorts. And that's why they get scared every time AMC is raising money. You can see, apes always believe we needed a market crash to get things going. Then Michael Burry comes and short the only company keeping the stock market afloat. Now announcing his plans for GameStop, all while silver is going crazy, the perfect storm is brewing. So we've talked multiple times about why a market crash is something that will allow the squeeze to happen because of the use of collaterals. And I wanted to bring this post from Samuel, which talks about, here's a hypothetical pod/basket scenario that you might see with Citadel to better understand these TRS positions. And I want to talk about it because it relates to what we talk about here with needing a market crash. So essentially you can see that in these basket, it's a mixture of different stocks, ones that they are long and ones that they are short. And in this case, the example, some of the ones you see that are long will be stocks like Tesla, Meta, Microsoft, and the ones that are short will be GameStop and AMC. And essentially how it is that they use these stocks that they are long as then the collaterals to then short these stocks that are AMC. So as long as they are able to see stocks like Tesla, see stocks like Nvidia going up, they will be used to then short AMC. They will see how that AMC will go down because of the fact these Nvidia stocks are going up. And so you will see the thing is that the moment their position in these long positions goes wrong, aka the market crash, we're going to be seeing how they can then contain these short positions that consist of AMC, that consist of GME. And so this is why we've said that a market crash is something that will trigger a squeeze. And now, at today's current day and age, at the current market economy, something that we're looking at is very, very likely. Because firstly, today's the first day of December. Instead of dropping to zero, the amount borrowed from the Fed standing repo increased to $25 billion already in the morning window. There couldn't be a louder warning about increasing liquidity stress in the banking system. So one of the things that indicates whether or not the market economy is going to crash is, of course, looking at the liquidity stress, especially the ones within the banking system, because they are ultimately what's keeping it alive right now. What we are looking at is the fact that there is a liquidity stress, is the fact that these banks are starting to fail, and the fact they need to borrow more money is showing that. And you have to realize that this is on top of the $50 billion last week, so a total of $75 billion in 1 week. And so this isn't just a one-off occasion. We've already shown on this channel multiple times how they are in need of this cash. We've shown how constantly there is money being injected into the system because the banks needs to borrow money, and that really just highlights the liquidity stress problem. If you want to take a look at the reverse repo, 3.2 billion. And we've already talked about this. When it comes to the repo, we have talked about how traders have already said that they do not actually want to borrow money from the repo because it shows that they are weak. They want to make the repo the last resort of borrowing money. And so the very fact we are seeing them actually borrow from the repo, despite saying they don't want to borrow from it, despite the fact they're saying it's showing weaknesses, is really just, agreeing to what we have been saying the whole time, with the market crashing, with the whole economy not looking good. And the fact we know that the market will be crashing, and then what we just talked about with how all of these long stocks will go down along with it, stocks like Nvidia that's holding the market up, we're going to be seeing how it's going to be crashing down. Another big thing that we focus on, something that is also matters for the market, Japanese 10-year government bond yield surges 1.84%, is the highest level since April of 2008. This chart is concerning to say the least. So if you want another indication, this is it. And the reason for this is first you have to understand, the next yen carry trade unwind will be unlike any former short-lived blips. And this is going to start a multi-month, multi-year unwind trend that is going to have a massive shock to the global financial market, which of course will affect the US market as well. And if you want to understand why, especially the fact that we're seeing how the government bond yield just hit 1.84%, is that for 3 decades, Japan was the anchor, zero rate, infinite liquidity, and the foundation upon which global carry trades were built. Trillions borrowed in yen, deployed into US treasuries, European bonds, emerging market debt, risk assets anywhere. So we've already talked about the yesterday. Now I will post this down below so you guys can obviously take a look, or if you want to pause the video as I scroll through all of this, you can take a look at this. But the reason why this is important, and just for a TLDR, is the fact that they essentially borrowed a lot of Japanese yen and then exchanged it into dollars to then buy all of these stocks. And what we've known is that because of this, a lot of stocks are built on inflated value. Because they've borrowed so much money, because there is infinite liquidity, they were able to borrow so much money to then pump up all of these stocks. But now, as we're seeing that is not a viable option anymore, as we're seeing it getting higher and higher, it comes to a point where they have to give back the money that they borrowed. But by doing so, they will need to liquidate all of the positions that is in the market right now, that is used to pump up the value. So you can understand why this is going to be affecting stocks like Nvidia, which have been pumped up by the value from these yen trades. And so is why we've said we're looking at the market crash. You can also see, amidst this, we're seeing Bitcoin falling $4,000 in 2 hours as mass liquidations return. And this is what we're going to be looking at. I think this is just a reflection, a small mirrored reflection of what will be happening throughout the whole market, is that we are going to be seeing panics like this, where we're going to be seeing mass liquidations return. We're going to be seeing a lot of longs being liquidated, and that will be the worrying problem for these institutions. Just like we said earlier with the basket, all of these long positions that will be liquidated will be the same thing that's happening here. And now, because of this, we're starting to see the GME warrant climbing. And this is something that I think is extremely interesting to see because of what it means, because of the timing that it's happening. And the fact that it's especially happening as the time that Barclays starts showing that GME's market cap climbing by 6.31 trillion. because of what's actually going on within the market. Now, as always, none of this is financial advice, so do take advice to go and sell. Make sure to do your own due diligence and research, and I'll catch you guys next time.